complexities are we are facing a lot of complexities in the reconciliations versus we are also receiving a lot of notices from the department regarding mismatches between the return filed and the data available in AIS TIS. With this brief background, I would, without taking much time, we would request and invite Chintan to start with the session. Before we commence, would request participants to raise their questions at each stage wherever the relevant topic is being covered, so that we can have a more interactive session throughout the whole of 2 hours. This will request Chintan to start with the session.
Yes, thank you, Minal bhai. First of all, as Giant Chartered Accountant Federation, I first would like to thank Lord Mahavira for his blessings to kindly enlighten us to the path of salvation. Uh, Pranam to Maharaj Sahib and warm welcome. Thank you to the Giant Chartered Accountant Federation Midtown for inviting me to give this session on the filing of income tax returns. As Minal bhai, you rightly said that the methodology has changed drastically in terms of how to approach an IT return. With the era of digitization and digital records being made available with the income tax department, it is more imperative for each and everyone to be more organized and do a data analysis before we file our IT returns. And in the entire process, the uh, not only the technical aspects of the law, but also the procedural aspects of the software and the various technical issues needs to be kept in mind while filing the IT return. So when we initially discussed with the topic with Miral Bhai, we I was trying to just think that when we are encompassing the income tax return as a filing, discussing on the income tax return, it basically encompasses the entire income tax act, because when you file the income tax return, you need to actually run through the entire income tax act in terms of your residential status, to the type of entity you are, to the nature of income, the classification, the accrual concepts, the exemption criteria, the deductions, and the credits of your taxes that is to be claimed. So basically, it encompasses the entire income tax act in a nutshell. But to cover this entire act in 2 hours is a very, I would say, a very big thing to do, that we cannot cover the entire act in 2 hours. So what we try to do is that we try to pick up the issues and the key points as tax consultants that we need to keep in mind when we are filing the income tax returns. So the screen share is available.
Yes,
Yes, sir.
Chintan.
Visible. Yes, sir.
So the objective of this session, when we discuss the objectives, that we have to keep the entire discussion around certain principles that what we want to discuss is. So the first point is that as consultants, we are uh, we are partners in nation building process, because one of the process of nation building is taxes, and every citizen of every person in India is required to file income tax return and ensure that the right taxes are being paid. But how to pay that taxes correctly is something that a tax consultant will probably advise or guide their clients. So our objective is ensure that correct and complete reporting of income taxes and their disclosures are being done. While filing the entire process, we have to also ensure that when we do not indulge or get into a process where we do so many mistakes or any issues that crop, which leads us to demand in intimations. Because most of the time, some technical errors will fade while filing the IT return. We will face some intimations from the department, and there's another round of entire work process which begins to ensure that the demand is reduced to nil. There can be situations that you are faced with the issues that it is bound to get some notices, but you ensure that when you are filing your IT return, it is correct. And whenever the matter comes up for any scrutiny or any kind of a intimation, demand, or anything, you should be in a position to defend those things at the higher level. And the last and the most important thing, sometimes it is most important that we have to build a safety net for the tax practitioners from the income tax department against the client's malpractice or their inability to justify their claims. So what happens is that clients, in the haste of saving tax, they might say, "अरे sir, जाने दो ना return, we'll claim it, देखा जाएगा." And then when the matter comes up, you say, "अरे sir, हमको कुछ नहीं मालूम, हमारे CA ने फाइल किया." So this is the standard things that sometimes now things crop up, and the way the tax departments are looking professionals, it is more imperative for us to build our protection around the our practice area. So with this objective in mind, we have identified few areas where we feel that we will be covering this entire session. Uh, Last but not least, but we are trying to cover that there can be areas beyond this, and there are areas beyond this which can be covered in this IT return. But considering the time frame that we have and the topics that we have to cover, I thought that we will be able to cover these things in the session. So residential status. So very important aspect of the residential status is that is the very first point that one has to decide that what is the status of the client, whether he's resident, he's non-resident, whether he's a ordinary resident or a non-ordinary resident, or whether he falls under the deeming provisions of a residentialship. So it is more important that that to determine the residence status, because now the exchange of information which is happening across the countries, it is more important that you are aware as consultant that whether your client's residential status is resident or non-resident. So one of the process of evaluating is that you evaluate his residential status based on the actual number of days stay in India. So you need to obtain the passport records, the stamp on this passport to determine his stay in India, the in and out of the records available. Based on that, you calculate the number of days stay. You consider both days as inclusive, and the second way is that you also obtain a tax residency certificate. So whenever the client determination is finalized that he is a non-resident, then the next question arises that you're resident of which country. So to determine the residential status of any country, you need to have a tax residency certificate. Tax residency certificate assumes a lot of importance because the tax treaty benefits are available to a non-resident. Now, the treaty benefit as per the countries, there are situations where the tax is not there as per the treaty, and therefore the tax is reduced to zero. To claim those benefits, it is necessary that the non-resident has a tax residency certificate, without which he is not able to claim the treaty benefit, and hence the entire benefit the non-resident loses out the benefit of double DTAA benefits. So once you identify that is a resident of that country, you also obtain the tax identification number of the country of the tax resident. This information you need to required to be put in the IT return in the residential status criteria. So this information you have to obtain in case of individual citizens or Indian people having the passport. In those cases, you can, if they don't provide the tax identification number, then you can provide the passport number. In the residential status criteria is one of the criteria is where there is an Indian citizen who is a non-resident who stays less than 180 days in India, and he unfortunately doesn't become a tax resident of any other country. Say for example, 90 days in US and 90 days in UAE. So he doesn't cover more than 180 days in any of the countries, and therefore he doesn't become a resident of any of the country. And he is an Indian citizen, but and his income is more than 15 lakhs, which is in India. So in those cases, the income tax has defined them as to be a deemed residence. And in case when you are deemed resident, your only Indian income is you are treated as a not ordinary resident. And therefore, these conditions you need to test to determine the residency status of your clients?
Then I would like to just add to this point. Issue could arise. What could be the income which is deemed to be in India? So the condition in the rules section 61A for this deemed residency requires that if some person is not a tax resident of any company, any other country other than India, and as an income which is not a foreign income, the Indian income, anything other than a foreign income more than 15 lakhs. So here the issues could arise as far as what incomes are deemed to arise in India. So we need to analyze the client's individual returns and facts, and then take a call whether we would like to show this individual as a resident or a non-resident while filing the return. This is one area where it could pose a lot of challenges in filing returns. So we do have a query in this regard. I'll just So Deepak would like to inquire that should deemed resident in 15 lakhs criteria disclose foreign assets? Now that would depend on whether once we determine that he's a resident, the second stage would be to determine whether he's a resident and ordinary resident or resident but not ordinary resident. So basis that we'll have to take a call whether those foreign assets needs to be declared. Anything to add from your? Then you would like to add something?
Yeah, correct. So basically, disclosure of so the disclosure of the foreign assets and liabilities are applicable to residents and ordinary residents. Not ordinary residents are not required to provide the annual foreign assets and liabilities details. So to that extent, that there is a cushion available for them also to treat them. But at the same time, once you determine them as an ordinary and not ordinary resident, you have to also ensure that the transfer pricing provisions are applicable between a transaction with a resident and a not ordinary resident. So whenever there is a transaction of that not ordinary resident, which is relatives, or there is an income which where is connected, where there can be a transfer pricing exposure. So one needs to also evaluate this aspect, that whether once you determine him as a not ordinary resident, also evaluate the transfer pricing implications also.
And further in this regard, when we are saying that a person is not liable to tax in any other country, in that we need to also check whether if someone is liable to give is eligible for some kind of an exemption. So though he's a tax resident of a particular country, and he may not be liable to pay taxes basis some kind of exemption, but then we need to think whether will he be treated as a tax resident of that country. So if so, even if he's not paying actual taxes because of some exemptions, he will be treated as a tax resident of that country, and this deemed residency probably should not attract on that in this case.
Correct. So the words liable to tax is not to be interpreted in a manner where there has to be some kind of a tax on that particular thing. There are countries which doesn't tax individuals as their taxation ecosystem. So does that mean that for all the people who are residing abroad in those countries who are Indian citizens are considered as deemed residents provided that the condition of 15 lakh is reached? The answer is no. It's the question is that the liable to tax means that he is within the framework of that country's system where he is falling as a tax resident. That's it. The liability may not accrue by virtue of certain exemptions available to that particular individual in the host country itself.
Correct. We can move forward
So,
on this. Any
correct.
questions in
So,
this regard, or we can move to the next issue?
correct. So, one of the other point is that, in case of the seafarers, that, how do you determine the residence status of the seafarers because they are on the voyage outside India? And how do you determine their number of days stay? What document would probably is required as tax consultants to evaluate his residential status? So, in this condition, there is one particular notification which has been given. Notification number 70 of 2015. Basically, in case of an Indian citizen who is a member of a crew of a ship, the period of stay shall be determined based on this continuous discharge certificate. Now, under the Merchant Shipping Act, this document is a must to be given by the ship ship owner, that the person who is on the crew member who is on the ship every person is required to have a continuous discharge certificate. The entry of the voyage, the exit of the voyage details are mentioned in the document. Now, this document helps in determining the residential status of a seafarer. Now, as I said in the earlier presentation in terms of my objectives, that what are the one of the objectives was to ensure to prepare a safety net for the tax professionals. So what happens in most of the non-resident cases that the client may not share his passport stamp records accurately. He might say, "Sir, I was present in India for say 110 days or 100 days." So then you don't evaluate that 120 days criteria. So all these matters may crop up. So in those cases, one can always send the tax computation to the client along with a note saying that in the absence of the actual stamp records, we rely on the declaration on the number of days stay in India. These numbers we anyways required to be produced if, at the time of scrutiny or any departmental inquiry where they want to evaluate the residential status. So at that time, this information will be required to produce. And in case if you fail to produce, there is a penalty provision associated depending on the tax liability that may arise. So by this way, you are protecting yourself as consultant that you have intimated or educated your client on the provisions of taxation, which your client accepted this knowledge and he still went ahead. So whatever he is wrong is been done, it is his awareness rather than the negligence of a chartered accountant. Or even sometimes the client says that, "अरे sir, you should have told me, आपने नहीं बताया हमको कैसे पता चलेगा?" So all these things, once you have in written in email, you are at least protected that, "Sir, I have already mailed to you. It is your duty to read and to reply." So these are few disclaimers that we have thought of that we can share. These are only just for an example to give your position that how you can build your protections. That we believe that you are in possession of a tax residency certificate to claim treaty benefits. So these are the documents which are necessary. Every non-resident has to have to claim a treaty benefit. So now the other point that we move on of the other important areas is the heads of income. So here basically broadly what we have tried to cover is the five heads of income as what we are is been given in the Income Tax Act. And while determining the heads of income and these taxation, it itself is a separate chapter. There is, that each of these sections are so detailed and a lot of issues are there in each of these things. But the whole idea over here is not to get into the taxation nitty-gritties, but rather the disclosure and the computational working nitty-gritties of these sections. So now, with the advent of AIS, Annual Information Statement, 26 AS, GST portal, it is more imperative for everyone that you have to reconcile your income tax return records with the 26 AS, AIS, and GST portal, especially in case of a business income, where you are reporting your turnover for the purpose of 44 AD. Now your turnover should match with GST data. So is there a matching or is there something, there's a mismatch? You need to have a reconciliation of the same. So one more point that we also advise is that whenever the client is approached, we ask that you prepare a draft balance sheet of the client to identify his assets and the incomes associated to such assets. So basically, this acts as a control mechanism for a tax practitioner to understand his client very well, to understand his assets, so that one can identify the incomes associated to such assets. So how many immobile properties is he holding? As per tax, you are allowed to hold only two residential house. So moment you have a third residential house, you can very well have a immediate attention that, sir, out of the three, one you have to offer for as deemed income, deemed rental income. So these information, this data will really help as client that what needs to be considered by filing the IT returns. This is more important that to have the list of bank accounts maintained. Now, sometimes we have came across that client has shared only three bank statements, and when we started preparing the IT return, when we ran through the AIS, we realized that the client is maintaining five bank accounts. The moment we questioned him, sir, there are two more bank accounts in your name. then we realize that हाँ दो गांव में है वो, when we have two accounts in our village where we had opened up, so and there are transactions happening in those accounts. So then it gives an insight that it gives a control point as a tax filer or a tax professional, so that you can have a proper control on your client, and there is complete and accurate reporting that can be done. Now, we are going to the heads of income, the salary income. So, what question that generally arises is that while preparing the Form 16, the employer might have taken the new regime and without any deductions simply deducted the tax and paid the taxes and filed is given is the Form 16. While evaluating his ITR, one may identify that the old scheme is beneficial to him rather than the new scheme. So in those cases, it's more uh, as good as an assessment in the case of an associate appears in the hands of, you have to do like an assessment that all the deductions that he's claiming has to be verified, is the proper records available or not, so that when you are filing the IT return, you file the accurate and correct deductions and claims. Uh, a new disclosure has been added this year where for income from retirement benefits, where disclosure in terms of section 89A as we have claimed in earlier years. So basically 89A was a relief where you have suddenly an income in year one, and then you have income less income regularly in year two, and three, and four. So in that case, had this income been earned in that respective years, there would have been lesser tax. So then you claim a relief under section 89A. So this is basically a kind of a provision where they want to collect the information digitally from the assessee that wherever the 89A relief has been claimed, those records are made available in the system and they can verify and keep a tab on their future claims also. So in terms of the house property, uh, so house property, it's very important that you understand that how many assets the client possesses. Sometimes the client has the asset in where he's located and still he's staying on rent because in the house where he's living is probably a distance from his office in a city like Bombay where you have a flat in Virar, but traveling from Virar to Churchgate is a big time cost or big time travel and challenges in train. So person says that I maybe shift my renting to somewhere near Dadar, and within, so therefore whether he can claim this benefit of claim that as one as self-occupied property and the other as claim as HRA benefit under Form 16. So these are the challenges that can be faced while filing the IT return. Second is that while filing this income from house property, one needs to also obtain the tenant records, tenant name, his PAN, his address. All these important because now the data is being reconciled from all the corners, especially the high rental income where the rental income is more than 50,000 a month or crosses 6 lakhs a year. So because the TDS deductions are available at those stages where the TDS has not been deducted, but since you report it, the department can come across to information that this is the tenant who has not deducted his TDS. So this data is really actually collated by the department through this information is actually working as a cross verification process to ensure that the correct taxes have been paid or not.
Chintan,
Second is that
I would like to add here that PAN number and the PAN number of the tenant in case TDS is applicable, that should be properly entered in the TDS as well as the house property schedule, including the TAN and PAN
correct.
respective. In case if it's under 194IB or it's under 194I, any issues in there could lead to non-credit of the TDS on the
Correct.
rental.
Correct, correct. So even especially as you rightly pointed out that to claim the credits, the mapping systems built into the ITRs is the control system that they've built is a PAN linking system or a TAN linking system. So wherever the TAN number is there, you mention TAN number. Wherever the PAN number is there, you mention the PAN number. The respective sections also defines that which section under which the tax has been deducted. And this information is also more important, especially where where the rent is been paid and by the corporates. When the corporates, then this information is also being used internally between GST and income tax to ensure that the RCM is also paid on the rental side of the expenditure of the company. So this now information is making so much robust that it does not restrict itself to income tax but also to GST regime also. Uh, see, what one in one of our clients, what we have faced is one of an issue where the my client was has given his flat on rent. The person to whom the rent was the tenant was a salaried employee. What he has done is that the salaried employee has given a declared details about the rental details to his employer so that while filing his 24Q returns, the entire information about the HRA claim is being correctly to be mentioned correctly in the 24Q form. So while mentioning there, the rent amount paid to that landlord was shown higher. Result of which, while we got the information in the AIS, we found out that the rent income shown in the AIS was more than the actual rental income. So, you can find this kind of discrepancies. And therefore, at that time, it is more important that if you have the documentation rightly maintained between the tenant and the landlord, this information probably help you to ensure that whenever you receive a notice and intimation, to have a legitimate reply available that this is my agreement and based on this it is done. It is the fault on the side of the company rather than on the assessee side that the income is underreported. And the second option is that what we advise is that in the AIS, you have a feedback option. So in the feedback option, you can probably give a reply saying that this rental income you deny on the quantum of amount because this is incorrectly been mentioned by the deductor. We do not agree to this information. So to that extent, at least you are giving a true and correct disclosure and information at the relevant forum to ensure that you A, not get a notice. B, even if you get a notice, you are able to defend that notice. So keeping our objectives and principles, you have all the things being covered in this particular system. You have to ensure the property ownership details. So, here it's very important that you mention the property ownership details because the moment you declare rental income to a file which has no tax, and then when you want to sell it, you shall offer that particular rental property sale in the hands of the other owner. So, that jugglery is now no more available possible because the information over here is that moment you have this address information, pin code information available for a particular assessee in the ratios defined, and then when you sell that property that time your ownership ratios might be compared. We don't know today if this mechanism works or not, but knowing that this information is being collected tomorrow, if they want to do a such kind of an AI intelligence on the data that they have, and then in such situations we have to be more careful that this information is correctly mentioned. So the most tricky portion is the business income. So business income is we are covering the non-audit cases over here. And the first thing is that we advise is to have a reconciliation with GST records so that whatever the turnover that you are offering in the 44AD scheme, your turnover is matching with the GST records. Whenever you have incidents where you are following cash method and the GST is under the credit method wherever the invoices are raised. So in those cases only that you have to ensure that you have a proper reconciliation available, your proper banking records are made available at your disposal, so that your this kind of differences will definitely will come up for questioning at the intimation level, and you have to produce such reconciliations to justify your stand that your turnover as per GST is not the turnover as per the income tax act. Now, lot of because of the COVID and situation, we have found that lot of many people have diverted lot of their time and activities towards stock market. So, and the considering the volumes that have been increasing day by day in the futures and options segment, especially, and the trading activities being undertaken, the income tax department has come up with a new particular reporting criteria under the trading head, where you can report your turnover from intraday trading and all that activities. So basically, intraday trading covers under speculation activities, and speculation profits, speculation losses can be settled off only against the speculation profits only. So therefore, it becomes easy for the department to identify these transactions because your everyday trade data is being reported to the income tax authorities. So they have all the transactions under your PAN with them, and they can very well evaluate and using the for AI intelligence on this data, they can very well evaluate it, your conduct, your activities, your modus operandi of the frequency with which you are doing trading. They may tomorrow come up with more scientific evidence to define that what is your capital profits or whether it is your revenue profits. So one has to be very careful when using that your income from share market is to be treated as business income or to be treated as capital gains. Again, in the futures and options, it is given under the guidance note that how you should compute the turnover. So you have to refer your guidance note accordingly to determine the turnover criteria. The criteria for the futures is that you take the absolute of the differences of the profits and losses and you determine the turnover. And the same applies in the case of options, plus you add the options which are sold as the premium which you have collected as the turnover. Uh, One of the points that is important is to have your balance sheet items also prepared because in the books not maintained criteria, there is a section where you have to report the balance sheet items. And in the balance sheet items, those most of the things are not mandatory except for the four aspects, but they still are open enough to question you that your what will be your profits and everything. So it is better, you have certain information, some records where you are able to produce some balance sheet items. Uh, Capital gains. So under the capital gains, the important aspect is that you have to enter the data based on the advanced tax due date period. So you have capital gains and you just report it as one amount totality. That is not the thing. You have to report each of your gain data as per the advanced tax due date records. Because your advanced tax liability in case of a capital gains arises in the quarter in which the gain is arrived. So it is important that your capital gain data is put mentioned in the respective due date sections. Otherwise, it will capture the first quarter information, and if at all there is a tax liability, you will be saddled with interest cost unnecessary on the entire things. Second is that we advise to reconcile the AIS information with the broker report. Now, what happens is that sometimes the broker might have done some error at this reporting level, and you have an information and there's broker report suggests something else. So you can identify mistakes at the broker level where you can reconcile and confirm that your data is accurately being offered for tax. In case of mutual funds, most of the time clients don't when they redeem just to get the money and they have the redemption records as the redemption slip, but the capital gains data is not available with them ready at this juncture. They sometimes book directly as direct scheme. In direct scheme, there is no agent, or they have done through some agent, but that agent they are not in touch with those agents, or that agent is not capable to have certain systems where through which he can generate the report. So one of the best methods that we have adopted is that on the CAMS website and on the KFinTech website there is an option where you can download the capital gains report and you have to mention the email ID and the PAN number of the client which is registered in love with the AMCs and all the AMCs falling under CAMPS and other MCs which are falling under KFinTech. So the entire universe or mutual fund is basically covered under CAMPS and KFinTech. So it doesn't matter the client doesn't have any information. You simply just go to these websites, do a registration. There's an option to generate the report in PDF, Excel, and you accordingly just mention that in what format you want, and you send the information. In span of few minutes, you get the document at your disposal, and by which that you have a authentic data through which you can actually file your capital gains returns for your mutual funds. Uh,
Yeah, Chintan, I would like to add something about the broker's report versus the AIS information.
yeah.
Uh, in regard to the broker's report, most of the online broking firms, Zerodha, ICICI Securities, most of the online broking firms are giving a ready-made capital gain statement, which could be easily downloaded and in Excel, PDF, and can be used for preparation of return. However, with the caveat that that particular broker would prepare that capital gain statement basis the purchase data or securities purchase details basis available in his demat account. So in case a assessee is having multiple demat accounts, we will need to be a bit cautious about how to calculate the breakup of long term and short term. So in that case, we need to be cautious about using the data which is available directly from the broker's website, the capital gain statement. Uh, uh, so any feedback or suggestions on this side, Chetan?
So yeah, so what happens, Mrinal, what you pointed out is the fact, whenever there is a transfer from one demat to another demat, okay. So whenever there's a transfer from one demat to another demat, the broker in whose demat the data is being the shares are transferred, he takes the date of purchase as the date on which he receives the stock, not as the actual date, because the actual date data is available with the previous broker, previous demat records. So in those cases, you have to, we as tax consultants, you may not have been possession or may not be aware that there is a change in record from one demat to another. So as a part of the questionnaire, you also address this point to your client that this profit that we are determining, is there any transfer of stock from one demat to another demat? If he says yes, then you identify those stocks, and based on those stocks, you inquire whether at what date they were acquired in the previous demat records, and through that data you can probably calculate the sales taxation. So this happened to one of our clients, and we were unable to obtain the old records. So we said that sir, it is difficult to identify from old records. What we can do is that either we go on the declaration that was purchased before 31st January 2018, and we take the grandfathering cost straight away and we file the returns, and we establish through the demat statement that this was entry from the another demat, and the
Yes.
period of holding records is available as on the 31st January 2018 if it's available, and we are able to produce that document. We are taking that view that it is before 31st January 2018, hence I'm taking the grandfathering cost.
Similar issues arise also in the case of mutual funds. A lot of times, clients would have done a lot of switch in and switch out from one mutual fund to the other, data of which may not be available in the bank statement. Further, there are similar cases where a client would have opted out of direct. There are multiple mutual funds which have a direct as well as a regular scheme. So if you purchased from a broker, mutual fund ISN would be as for a regular scheme. Whereas if you bought that same fund, mutual fund from the website of that mutual fund directly from the fund, it would be a direct mutual fund. Now, at times, a switch in, switch out between these things, the fund remaining same. It is just that we have removed the details of the broker. In that case, these transactions are being reported as redemption from the mutual funds side. So we need to take a call whether this would be a transfer wherein the ISIN also is gets changed from one fund to the other. So, and these are reported in the AIS. This gets reported. So we need to take a call whether this would be a transfer of asset and whether capital gains to be offered on this transaction.
Yeah, correct, Mrinal bhai. So what happens is that the clients may not redeem the entire portfolio, but they may switch out from one scheme to another scheme. And in those cases, the switching out is considered as a taxable event, and the capital gains tax is applicable on such transactions. Now, to determine those transactions, to identify those transactions is difficult as a tax consultant, because when you prepare a bank summary, you don't find these transactions, and therefore it is very likelihood that you may miss out. And therefore, we said that in our point number three in the slide that you obtain the reports from the CAMS and K FinTech portal. When you do this kind of a thing, you are actually getting all the information, not only of just the redemption. but also of the switch out things that are happened. Also, in this report, you get the whether the gains are from grandfathering rates are also being provided, that the long term is given in the two slabs. One as a grandfathering profit and other is the other than grandfathering profits in terms of the long term. So we have all the summary available in those reports. And the beauty is that you can also obtain in Excel format. So it becomes all the more easy, when you want to compute your calculate the data and have those feeding points. It becomes easy for you to input into the systems. Okay. So again, this while you there is one more thing is that when you have a property, so there is a capital gain in terms of a property if you are selling it, and you are supposed to file the IT return in those such cases. So, so in those cases, what happens is that you have to the cost of acquisition is important. So your cost of acquisition cases, you have to also check whether the property is acquired prior to 1/4/2000 or not. If it is acquired prior to 1/4/2000, we have to have a valuation report on that date, which will enable us to identify the real cost as on 1/4/2000, have an indexation on those cost of acquisition and calculate the capital gains tax. So this is also one of the important aspects that when you are calculating the capital gains, you have to evaluate. Also, we advise that you check the index to copies. Index to copies are the basically summarizes your the transaction cost, price, your market value, and that date, the property description details and everything. So, if 50C valuation is also important that you have to check while selling the property. That is this is there any taxation arising because of the section 50C provisions or not? And the last is that in case of a STD paid shares and mutual funds, you ensure that the grandfathering provisions are taken care of. You may not wrongly just pay tax on the old provisions without mentioning those things. And in case of these STD paid shares and mutual funds, you need to mention the ISIN code of the shares which are being taxed, which are being offered as the law grandfathering provisions. Now, post this, definitely there's a VDA that has been introduced under the heads of business income and capital gains. But I've taken VDA as a separate topic in itself, so therefore I have not covered there as VDA. I'm covering this the income from income from other sources, which is the fifth source. So this is source of information is very difficult to obtain, as well as you have certain avenues more now available at your disposal to identify what could be the sources income from other sources. Earlier, AIS was not there as our support system, and it was difficult to inquire and dig information. Sir, give me the bank statements. Give me all the bank statements to calculate your bank interest, and then identify fixed deposit interest, obtain interest certificates. All this was a very tedious process for the clients also to approach their bankers and obtain those documents and provide to a tax consultant. Now, thanks to this AIS system introduced by the government, this is really been assisting the tax preparers in terms of the compiling the tax returns of the assessees. Now, one of the aspects that when you want to check the income from other sources is to check the bank's credit side summary. We advise that all take the summarize all the credits, because ultimately it's the credits which defines your income. So whether all the credits, you classify the credits and reconcile with the various heads of income to evaluate whether there is any tax or not. Then you use the AIS data for reconciliation of FD interest with the interest certificates, dividend income, the interest on income tax refunds. Most of the times earlier, nobody used to report the interest on the income tax refunds. Now, because of this information available, the amount of refund which is there, the department can easily have their information at their disposal digitally that there is an interest on earned on this income. So if you don't report it, it is very likely that you might be getting an intimation that you have missed to report interest on income tax refunds. uh, Bonds and LCD interest. Now, from the current financial year onwards, the government has amended the TDS provisions on bond and interest income. This year, the previous year onward till last year, it is difficult, to obtain this bond interest and the NCD interest because unless the interest are credited to the bank account, it is difficult to capture. Unless, as I starting of the slide, I mentioned that you prepare a draft balance sheet where you can list down all the assets, your fixed assets, your liquid assets, your investment assets, and from there, if you can identify that the list of NCDs that you hold and the coupon rate that is available and the amount that you invested, you can identify the interest income attributable to each of these investments, and from there you can probably calculate the bond interest and the NCD interest. Again, this as this index to copy. This is very important because most of the times you only focus on the credit side, the income side, and all that. On the expenditure side, if the assessee has purchased any property, it is very much important that as consultants, we inquire on the obtain the index to copy document from the client to identify whether the property which he has purchased is less than the stamp duty value or not. Because if it is less than the stamp duty value, then probably you are attracted the provisions of section 56 to 10, and therefore it would be amounted as income in the hands of the assessee. So it is very much important that you evaluate these kind of transactions, especially the gift transactions where the relation is been established or not. One has to check the relationship aspects also. And again, this details of the retirement benefits have been covered under the 89A also, one which is in salary as well as in the income from other sources. Any questions up to now before we move?
Then
Okay.
you will be
So
covering the VDA separately, right? Virtual
yes, video
digital.
is covered.
Okay.
Correct. So here again, in terms of the disclaimers, I would say that the clients uh, wherever the client is claiming the business expenditure or they are claiming any particular deductions or any exemptions, especially in case of a salary, where his Form 16 was prepared under the old new regime, and now you are proposing to file under the old regime, as you believe that the tax under the old regime is lesser. So in those cases, the major deductions is one of the major deductions is HRA claims. In such HRA claims, to ensure that the proper agreements are there in with the clients, or whether the rent receipts are being available, whether the rents are being consistently paid every month or not, whether the bank's evidence of payment of rent is also available or not. So all these situations, it's very important that you have this information at your possession to evaluate and advise the client. And whenever the clients will insist that no, please claim it, will see at the level if the scrutiny arises. So in such cases, you have to ensure that you are protected. You are making client aware that in case you choose not to offer any income, then at least you create awareness about the penalty provisions. That there can be penalty provisions attracted in such cases, and uh, what is the advantage of not disclosing? Because the moment you not disclose, you actually expose your 100% of the income not so offered as taxation. Rather, by disclosing, you at least have 70% at your disposal. 30% is the tax, assuming it is the higher tax bracket. So it is educating the client on the penalty provisions will probably make him realize that there is no benefit or incentive in not offering any income or doing any malpractices. So discouraging such malpractice is also part of our uh, tax advice. Deductions, one of the burning topics of the discussions, is the political party deductions because in the most of the deductions regime, there is some kind of information that is available. ATC again, PPF investments, you have passbooks available, you have the uh, investments in LIC standard where you can actually obtain the interest LIC premiums available from the LIC website, that you can obtain the entire list of premiums that you paid for the financial year. For Mediclaim also, the most of the things people are paying Mediclaim because they are aware of the medical cost associated, so they generally pay medical premiums. But the donations is a concept where most of the time the assessees try to flout the law by claiming bogus donation benefits. So to plug this thing is one of the aspects that the government has brought in is to introduce this form 10B as for donation proof. They are basically asking the to mention the ARN number of the Form 10B to claim the 80G donation benefits. But in case of a political party donations, it is just you have to mention the figure in the return. That's it. There is no disclosure of which political party donations you are making to. So your and the benefit is very huge because there is 100% deductions available to the assessee. So in such cases, it is more important that you obtain the donation receipts, you verify with the bank statement whether the payments have been made, and one of the other cross verification that one can do is to check whether that political party donation, the political party's name is cancelled or not on the electoral trust website. So based on these checks, you can probably ensure that the correct political party donations are being claimed as deductions. Uh, One more point is that sometimes the assessee is doing business. Most of assessees who are doing business income, or they are not claiming any rental HRA benefits. So then for them is one of the options is to claim 80GG benefit for the rent paid. So while claiming 80GG rent paid, assessee has to file Form 10BA, which is a declaration that you are not claiming the benefit of a self-occupied property on the house in any other location or the same location as you are employed. So basically, the place where you are employed, you are not claiming SOP also and claiming 80GG also over here. So you are not allowed to claim both the benefits. So this declaration is more important that you ensure that when you're claiming this kind of benefit, you also file this declaration of 10 Form BA. As I said, that every procedure is to be backed with certain safety nets. We are building one safety net that you believe that you are in possession of the investment proof because that you propose to claim. Because in the absence of any document will lead to not only reversal of deductions, but may also result into penalties which ranges from 100 to 200% of the tax you levied. So ultimately, you land up paying not only tax, you will end up paying penalties. There is no incentive for you to do any kind of a malpractice where you claim something which will not result anything to you in the long run. So it's a good practice to discourage the client from doing all these wrong claims. And also, when the client wants to insist that he still wants to claim, at least as tax professionals, we are protected that we have educated our client and our client still went ahead. So it is not my responsibility that whether I have filed my IT return, whether I have filed the IT return or not, but that liability is not on my head that I have advised him to do such kind of practice. Recently, there was a lot of document which was circulating in the WhatsApp group regarding where in one of the jurisdiction, the person as officer has inquired that give the details of the tax return preparers, whether which CA which CA you have filed your IT returns, and they want because there was some wrong claims being made by the SSC. Now, I believe whether this notice is valid or a fake notice circulating in the media, but there is so penalty with the way the department is looking towards chartered accountants that they are the prime source of such kind of frauds with the department, and the way the PMA Act has been drafted as to ensure that only chartered accountants and other professionals are being covered in any of the wrongdoing. It is more of imperative for us to defend ourselves through such kind of disclosures in the to the client while sending the tax computations for the approval. Now, one of the important leg of your tax filing is the tax credits. Now, tax credit is very important because the the mapping of your tax credit, the income associated to that tax credit, and the income offered into your IT return has to be reconciled. Otherwise, you may not get the credits of your income. Say, for example, the income you have offered is 100 and the tax credit available is for 200. The department will do a proportionate calculation and give you only credit attributable towards the 100 and not on the entire 200. In cases we know where the deductor has inadvertently done a higher deduction and he has deducted more, but your income is not more, deduction was more. So they don't realize because it's a system which is working and therefore they restrict this credit. to the income which is proportionately offered. So in such cases, it's very important that where you have to ensure your correct incomes have been offered and you are claiming the credits to that extent. So important is to reconcile the income accruing as per the books versus the TDS credits available in 26 AS. Now, one of the queries that we have received is that assessee, while filing his IT return, the credits which are available in 26 AS, he has claimed it. But after filing his IT return, if somebody has revised this TDS form 26 AS, and in that the additional credits were being given to him. Now, the assessee intends to claim such additional claim amount as credits because the credits at the time when he was filing the IT return was not available, but the corresponding income was being offered for by him, and therefore he had paid the tax out of his own self-assessment tax rather than claiming through an credit by way of a TDS. So in such situations, the department today is not the assessee today is not in a position to claim such credit because a his revised return time is over. Two, when you try to file through as a rectification return, there is a challenge which they are facing that in the rectification return, this is being amount as additional credits, additional claims. So the rectification return restricts your rectification process under the guise of additional claim, and therefore you are not able to claim such credits. So it is more important that you identify the income accrued and then analyze on each of these income whether the TDS has been deducted by the party or not. Whether he has credited in 26 years is secondary. Identify the actual credits that you are supposed to receive. As against that, what you have received in 26 years, that is more important in terms of reconciling your TDS credit. So it is this practice one has to develop and claim those credits in the IT return. Though today it is not available, you may face a demand that this credit is not available in pay self-assessment tax. That is fine. The moment the day he files this credit TDS, your demand will go away automatically. So at least to that extent, you are cushioned or protected that there is the credits that you have already claimed, but it is just a matter of the third party was not put it in your case. So
So
in
Chintan, if someone has missed to claim a particular credit in the return and shown the offered the income as net of TDS, what was probably received by him after the TDS deduction, and the date for revised return is already expired. So in that case, how is the option of filing an appeal, and how should someone go about filing an appeal against this if the rectification option is not available?
so here, Binal bhai, things are that technically speaking, the department should provide a mechanism to allow such kind of credit because allowing a credit is the fundamental right of a taxpayer. You cannot take away that right merely because that it was not claimed by him in the return. There is a old circular in the case where the Supreme Court judgment in the case of Goetza, where the judgment was held that since filing an additional claim through a revised return or without a revised return, additional claim at the time of assessment level is not to be entertained. But then there is an old circular which says that the assessee has to compute the right tax. The assessing officer has to compute the right tax and collect, and as per the constitution of the country, he is supposed to collect only legitimate tax. Any amount in excess of legitimate tax has to be returned to the taxpayer. It's a fundamental principle. So that fundamental principles cannot be taken away. So, but as these are fundamental things and principal things, we don't believe that this will be sailing through easily at the lower level. You might have to file an appeal at the CITAP level, and the matter might reach to the tribunal level to that matter that the credits are right, a fundamental right of a taxpayer, and especially when he's already offered the income, you cannot take away that right to allow the credits. So that is
Similar
one aspect.
Now, similar issues also could arise when in due to difference in accounting methods of the income receiver and the income payer. So, in case the person who's following accounting accrual method, who's the income receiver, whereas the deductor is following a cash method, what happens is that the income is offered in a particular year, whereas the TDS is deducted by the deductor in subsequent years because the deductor is following a cash method. In that case, how does the SSE claim the credit which is reflected in subsequent years 26 years?
So this particular situation, till last year, there is no such mechanism available. Assessors, we were advising that you claim in the year when you receive it because you have no other option. And especially when it is more easy when the client has the other income on which the assessee has no deduction made by the clients. So in those cases, you can merge everything. The matter could sail through easy and claim the credits. So that is the best practice that we advise to the clients till now. Now I think they have come up with some new mechanism where the credits of the future years can be claimed.
Okay. So in the return itself, they have provided a mechanism because the credit may or may not actually come at the time of filing return also. For example, I have someone is offered the income in March 23 return AY 23-24, whereas the deductor following the cash method would deduct that income, the TDS of the same in assessment year 24-25.
Or
So in
25,
assess,
26 also, because it is the year
uh,
in which you make the payment. You decide that the year I will make the payment, I will deduct the TDS.
so at the time of accrual, if the income is offered, should the TDS also be offered or claimed at that year or in the year subsequent where the actual payment of TDS happens by the deductor?
So we would say that, simply go in the year in which you receive the credit because this is a deferral going to the future year, not of the previous year. And therefore, when you are certain that the credit is not available in the year of your invoice, then it doesn't make sense that you claim the credit and you litigate with the government that sir, this is the credit I will receive in future years. So there is no mechanism as of now available to map such a situation.
I suppose there's one Delhi ITT a case in case of Prakash Sunrise Healthcare, which says that irrespective of the year in which income is offered and the TDS claim is made, that should be allowed even if it's there in the different assessment years, unless the income is offered rightly. So probably that case could come handy in such cases.
Absolutely, Vinal bhai. But that's what I'm saying that these matters will definitely achieve success, but not at the lower level. The fact that even this case was decided by the Delhi tribunal, right?
Correct.
So the matter has traveled to the ITT level. So principal matters will always succeed. There is no doubt on that point. That because it's a fundamental right of every taxpayer to have his tax credit. But the point is that whether he'll be sailed through at a lower level is the worry. So today when we are preparing the IT returns, we have to also understand the mindset and the systems available at the disposal of the assessing officer as by the CPC, whether they will be able to provide me this kind of relief or not. So accordingly, if the system without fighting, if we are able to just manage in a year, in subsequent years, it makes more sense to claim it in the year in which it is received. And you always have a position to say that my income corresponding to it has to be offered for tax. If they have not mentioned in the year in which it is there, the question in 199 section, it says that the corresponding income must have been offered for tax. So as far as I have offered this income in any of the previous years, I am eligible to claim this tax credit. So I am satisfying all the conditions of the law.
So in that case, if you look at the procedure part, while filing the return in the year in which TDS claim appears, say for example, in our case, when the income was offered in AY 23-24, the TDS, say for example, is reflected in 24-25 assessment year, there's this column of gross income offered under the TDS schedule. So in that case, we would definitely go ahead and put it that the income is offered. However, in that particular year, it may not coincide with the actual head of income, where the income may not probably would have. There could be a mismatch or an inquiry in this regard.
Absolutely,
Uh,
absolutely. That's what I'm saying, Vinal bhai. That if you are lucky enough that you have the income on which there is no TDS deducted for the collection of your income, if you have certain portion on which tax is not deducted, this particular amount might subsume into that tax.
Hello.
But if you are owing only this income which is completely identifiable, then you will definitely face this kind of an inquiry and you have to justify That's a section as per 199. I'm only supposed to claim the credit for which the income has been offered for tax. Corresponding income has to be offered for tax. It is not necessary in the same year. It can be in earlier years also. So I have to only lead him to the conclusion that, sir, in this year this was the income and I have offered for tax. But the corresponding credit was available in this year, and therefore now I am claiming that credit, which is the fundamental right. But I would say that this is a very process which will be a time-consuming process, because the initial discussion will happen with CPC. CPC may not be in a position to take this forward. He may reject it. You have an option to file. You will have to go to the CIT appeal level, and that is where through proper presentation you can get the relief.
You may proceed.
I think, Chintan bhai, can we do this like showing net income in the year in which I am, and then the TDS where when and that amount would be shown in that period of only the TDS amount, and then we claim that.
No, sir. I would not do this practice. The very reason is that you are splitting your income into 2 years. So, which means that you are violating the principles of your own taxation.
You see, I am offering the taxes of the net which I have received. If that's it on accrual basis, if it is my income and I'm disclosing it, and TDS which I am receiving it in the next year, that I am claiming it, because that you can have it on the cash basis. That should not be an issue.
So you are basically following a hybrid system, which doesn't permit in the tax accounting standard. So section 145 does not allow you to follow hybrid system of accounting. Either follow mercantile or cash method.
That's what I'm saying. Hybrid, in a sense, not a hybrid. I'm claiming the income when net I'm talking, which I am going to be offering it, which I am supposed to receive it. But this is what the net, then what I have received the tax in the next year, and in that I will disclose it that much amount and claim the TDS.
So that is again I'm saying that it is a stopgap arrangement that you can do, but I would not advise such kind of an arrangement because it violates the
I
principle.
can understand. See, this is a way out. This is only this. I can understand. It is a little bit difficult, but usually we have been doing it and we have got that credit.
I appreciate, sir. But on a forum where I
obvious.
principally lead on a particular point, I cannot.
Agreed.
Okay. So, as I said that, ensure that the tax credits are claimed in respect of the income which is offered for taxation. And it doesn't happen that you claim a credit, the income of which is not offered in the same year or in the earlier years. If the income is offered in subsequent year and future years, especially in case where the assessee and chartered accountants were following cash method of accounting. And most of the cases where you do the audit provisions for our clients and the clients have deducted TDS in March itself. Most of the time we have a lot of credits available which you are supposed to claim in the subsequent year, in the year in which you are receiving the fees. So in such cases you ensure that you defer your TDS credits into the subsequent years and not claim in the year in which it is been deducted. Now the credits is one of the credits is the foreign tax credits. Now in case of a foreign tax credits, it is imperative that the assessee obtains, just like we obtain a TDS certificate, a foreign tax credit certificate from the country in which the tax has been deducted. And such foreign tax credits certificates are filed through Form 67 online on the income tax portal before filing your income tax returns. So this is a procedure, but nonetheless, even if you fail to file before filing the IT return, you still be able to claim it because there is a judgment to the event to the extent that a procedural delay cannot take away the fundamental right of a taxpayer to claim a tax credit. So again, the principles are still been covered through judgments. But as I said, going through judgments is a very tedious process, costly affair, going through the entire period of litigation through various levels. So it is better that we file the Form 67 before filing IT returns. And we should always advise our clients well in advance or inform them in advance that whenever you have a foreign transactions or foreign revenue, you keep in tap whether there is a foreign clients are deducting any taxes at source or not. If they are deducting taxes, keep collecting those certificates immediately so that at the time of ID return you need not rush or wait for them to provide those certificates, and you may lose out on this foreign tax credits at the initial level, and then you need to fight it out at the appellate level to get those benefits. So this issue we discussed, Mrinal bhai, you have rightly pointed out. So I have already covered in my slide, but since we take it in advance, I move on. The other point is, most of the times, this is a very important issue that most of the taxpayers fail to cover it. This issue is basically the tax credit transfer of the tax credits from one PAN to other PAN. Uh, this generally happens in case where you are having the joint ownership of a property or joint ownership in a project where the TDS is deducted in one person's hand, and you need to split the credits in the all other joint holders. So this is the mechanism through which most of the tax professionals are using it. But in this process, there is a particular procedure which has been given in the Rule 37BA. So it is most advisable for all the tax consultants to ensure these provisions are being complied in spirit. So not only just while filing return, you mention the PAN number, the income you want to transfer, and then you match the PAN numbers and you get the things done. But also ensure that you collect the proper documentation, declarations, so that tomorrow if there is this kind of a queries being raised of a tax credit transfer, you are able to justify and support with some evidence. Now, in case of this foreign tax credits or these credits, the disclaimers, they generally believe that the foreign tax credit certificates which the client has issued is as per the norms of the host country. There is no fake credit certificate being submitted, so that some kind of a document which is given which is not a foreign tax credit legitimate, and then end up paying as submitting false document. And and one of the precautions that you need to ensure that you have these declarations available in terms of a transfer of tax credits. So now what we are covering is the disclosures available required to be made in the income tax returns. So one of the disclosures is the foreign these disclosures that we believe that are important. These are not the only disclosures, but these we believe that we wanted to cover in the slides where we feel that this would be some kind of help to our fellow professionals in terms of covering the ID returns. So foreign tax assets. Now these are only applicable for resident and ordinary residents. As in the initial slide, Minalbhai, you have questioned me that the person is deemed resident and ordinary resident, whether he's supposed to disclose his foreign assets or what. Well, the answer is here that it is not applicable foreign. It's only applicable for resident and ordinary residents. Uh, Here you have to produce the records not from April to March, but from January to December. So this is the important aspect that you need to ensure that you are covering the data as on which period. Uh, there are three schedules in terms of reporting of assets. One is schedule of FA, a schedule of unlisted shares, and schedule of assets and liabilities. So the schedule foreign assets liabilities has also shares like a Facebook share which is unlisted, or any company share which is unlisted. So we report under unlisted category also. You report under asset liability category if you are not maintain if your income is more than 50 lakhs, and you are not doing business, or you're doing business, your these assets are other than your business assets. So all those assets you need to report under the assets and liability schedule. So even though you are reporting under, you have to report over here also. Hello. Uh, Whether to report if it is forming part of a balance sheet of the idea. Yes, even though you are reporting as part of the balance sheet, you still need to report here. Uh, so over here, when you actually though you are forming part of the balance sheet, you will not report in the assets and liability schedule. But in terms of the foreign assets and liability schedule, you are supposed to report. Uh, so if the resident in ordination is a signatory is outside India, whether it is applicable, yes. The answer is yes, because the one of the explanations to explanation 4 to section 139 says that a person who has provided directly or indirectly any consideration for the assets held for immediate or future benefit or for himself or any other person. So in this case, even though the signatory is somebody else outside India, but I am owning the assets, I have funded that asset, then in those cases, this particular reporting is still applicable. So what we have done is that we have one particular slide that we have covered, is what you need to disclose. So we have here we have considered two cases where one the person has sold some stock, the person on which he has received some dividend, and the third he has retained his stock. There are three situations. So how to disclose? So when you have this particular sale of a stock, here in 2022, the Ashwin bought X shares for $5,000, Y shares for $3,000, and the current value of this is 5,400, where he has received dividend of $150. Y shares he has sold for 3,100, and Z shares he has a current value of 2,500. Now, how will you disclose? So here it is a procedure of disclosing that X shares, Y shares, and Z shares, the country in which he is held, and the date on which he has acquired the interest, the initial investment value. These are based on the exchange rate that on the date of the transactions were happened. So this is the initial value of my investment. This is my closing value on this dates, respective dates. Here in this column, we will declare the amounts which I have received in terms of the shares that I have sold. So this 12,300 basically representing my dividend income, and this represents 2,54,000 my sale redemption amount. So 12,300 is basically the dividend declared in the year. Then yeah. So now Ashwin should also report his 2,54,000 shares sale proceeds from while lying in the custodial account. So he also report as the sale consideration. So whatever the balance the demat custodian has, so he custodian has 3 shares. So all the 3 shares value total is being reported as the peak balance 8,20,000, and the whatever the amount is received is the sale redemption amount. Now, in terms of claiming the foreign tax credits, so this is how the foreign tax credit mechanism will work. Is where the dividend income earned is in US is 8,19,000 rupees. The other income in India is earned is 41 lakhs. The total income is 50 lakhs. The tax on this income is says the total tax. Now on this 8,19,000, there is a 25% of foreign tax in US, the withholding tax, and therefore my foreign tax credit amount is 2,04,000. Now my average tax in India is the total tax is 13,65,000 divided by 50 lakhs is my average tax, which comes to 27%. Now my average tax is higher than my foreign tax, and therefore the foreign tax being the lower, I am claiming this credit entirely. Situation would have been reversed if my 7% and my average India was 25, I would have been restricted to 25 as the lower of the two. And this is how I would have claimed the foreign tax credit. Okay. Any questions on this?
Hello, Chintan bhai.
Yeah.
I have one question. So, in this number of shares wherein we are declaring like date of acquiring the interest, right?
Yes.
So say for example, if I have ESOPs coming from MNC, so I'll be getting that on different dates during the year, right?
Correct.
In that case, which date should I disclose? The first time in the year when I get the ESOPs, or some other date?
So ESOPs I think there are two things. One is the
Hmm.
date on which you are being granted the ESOP.
Correct.
The date on which you actually vest, you exercise your
Exercise.
right.
Correct.
So the date on which you exercise, the date on which you acquire.
Fine. Fine. And not the date of grant.
So date of grant is a right given to you, whether you
Correct. Correct.
exercise
It is.
or not.
Yeah. Yeah.
So unless you exercise, you are not required to report.
All right. So when I exercise and when the shares are actually credited, I should disclose that date.
Correct.
Okay. Fine. Thanks.
So I think the next point that I wanted to do is that the pass-through income. Now, in the case of a pass-through income, most of the times, assessing feels that how to report the pass-through income. So in the schedule of P, you have to mention the section under which you are covered, which is under section 15 UA, UB, whatever. Then the trust name that you have to mention, which particular from trust you have received it, the PAN of that particular trust for investment fund, and you define the source of income, the heads of income, and what heads of income you are basically receiving this particular amount. Other sources or capital gains, long term, short term, you have to define, and accordingly you mention the your current income which you have earned in that particular column.
Just
And
to
you
add,
have
Chintan bhai, even under the individual heads of income, the pass-through income, there are separate tabs to be reported. So for if it's a dividend or interest, they have separate tabs for reporting the pass-through income under the individual income schedules.
Yeah, so basically you have the separate schedule, no? Schedule PTI. So in the separate schedule PTI, you have to report all your income over here, and accordingly you get
No, no,
collected.
the similar tabs are available in the. So this is a reporting portion. Say for example, it's income from other sources. Then under the income from other sources tab,
Correct. So here,
there are
this is what I want to
separate tabs
draw
for
your attention.
reporting pass through. Yes.
Correct. So here, this is one for the other sources. This is one for the capital gains. So here you report this whatever is your other source income, and you report whatever is your capital gain income, and accordingly your most of the softwares they take care of this particular reporting. Where when the moment you enter this information, this particular, they accordingly capture depending on the classification of the source of income. They take the respective schedules and they report it.
So we need to reconcile the individual schedules versus the PTI schedule.
Correct.
Any challenges in the reporting of pass-through incomes? I understand that there are Form 64C is required to be obtained from the alternate investment funds. So, for example, if an SSC has invested in alternate investment funds where the income has been distributed, any challenges in reporting? Because a lot of times it's very difficult to get those 64Cs from the SSC. In absence of that Form 64. Is there any alternate mechanism where we can kind of report this income?
See, this AIS, the infra, all these companies, the business trust and the funds are being saddled with the responsibility under Section 285, 285A, where they are mandatory required to report all the transactions that they've done. Failure to report, there's a huge penalty imposed on the fund houses. So it's like reporting your transactions and they properly give it, and non-furnishing of this information may lead to huge penalties on them. So in the present scenario, there is no other alternative mechanism for the assessee to understand what is his income, unless it has been provided by the fund houses. So the only source of information today, which I understand, is through this information which they provide through this Form 64.
64C. So, though this similar reporting is available in 26AS, but the breakup of heads of income would not be available. So, for that, for Form 64C to the SSC to get those 64C would become very important in these cases.
Correct. So this basically acts as a source of information that what kind of income is being received or some kind of an income is received from this fund, this AIF or this InvIT or REIT or anything. And then, you can inquire with the client that what kind of revenue you have received. And then this one information leads to another information, and with the chain of information, you can probably get the entire data available for you. So the most burning topic is the VDA. Now, VDA this year, the income tax department has added one section of VDA, one in the business section and one in the capital gain section. And the reporting they have created in such a way that you have to mention the date of your sale and purchase. And each of your transaction is then reported independently, which means that if I purchase at whatever stage I have, but I made a sale at one date, then I have to use on one date sale information versus my purchase information. And then accordingly, whatever is the gain or loss, I have to report. Now the only question arises here is that when I have 4 purchases and 1 sale, what methodology I need to adopt in terms of determining my cost of purchase? Do I have to take an average cost or do I take a FIFO basis? Because each of these sale transactions is evaluated independently, that if that particular transaction is in profit or in loss. The moment it is in loss, that amount becomes zero. And whatever the plus profit amount are there have been taken as income. So even your same particular Bitcoin, for example, has been sold one for profit and one for loss. You are only allowed the ones which are in profits to be offered for tax. The one which are in loss are being completely ignored. And the fact that the reporting mechanism is made in such a manner that you are hello.
Yeah. Chintan, continue.
The reporting mechanism is made in such a manner that each transaction is reported independently. So all those arguments or questions that we were taken, that whether the net basis would be considered, and at least within the same class we would be offering the net one. So all those discussions have been put to rest by this particular mechanism. Now, whether this mechanism is a valid mechanism, can stand the test of law, is something that one needs to wait till someone takes a position and files their appeal or files a writ petition, and probably tries to evaluate the rate real position.
So in this case, we have a choice of offering the virtual digital assets under that business income or capital gain. So in that case, what is your take? How to determine whether do we have a benchmark of business versus capital gain under share transactions? Do we use the same benchmarks here, or is there anything you would like to add? How to determine it that way?
See, in my view, there is no particular logic in giving this kind of a situation in terms of determining. The only way one can look at it is that under capital gains, you have at least a proposition that you have to submit in that quarterly breakup sense. At least if you avoid that 234C provisions to that extent. Whereas in case of a business, it's completely applicable for the whole year. So it is apportioned in the whole year concept. Whereas in capital gains, you have the concept available for to avoid at least 234C. Rest all the mechanisms appears to be the same because your tax rate is defined as flat percentage. So there is no separate slab benefit or a rate benefit available in either of the situations. And therefore, in my view, it's one of the best suggestions would be that you rather offer in capital gains so that you at least have a quarterly payments. At least you can ensure your 234C is covered.
What about the deduction provision? So I understand that VDAs are taxed at 30% flat without any deductions under 80C or Chapter 6A.
Correct. So you are actually VDA is like a just simple lottery payment. Whatever you gain, you pay it off. There is no deductions, no benefits, nothing. Straight, simple, whatever is the plus profits, take it, pay tax. Whether you have incurred loss in the other transactions, eventually in net basis, have you have made profit or not, has no relevance. Each transaction is taken independently. Now the question is in terms of 194R, where you are getting bitcoins as a gift or as a part of your some transactions, and so how do you determine the value? So then probably in those cases, the value in 194R TDS, whatever has been deducted, you can consider those as the basis of your cost, and then we'll claim it as a deduction as cost of
In case
acquisition.
of in case you are receiving cryptos or bitcoins as your consideration, say for example, your professional work or trading of
Moment
goods.
I have received as professional fees, that is my business income. So I have offered it as my business income, and now my cost, that particular business income is nothing but my cost of acquiring this particular VDA. Assuming that the transaction is split up into two, one as a receipt of my fees and then I purchase a VDA, then that whatever allowed as my cost. Instead of that transaction cash flow movement, I summarily say that I have received VDA directly instead of making the buying VDA. So in those situations, this I would treat it that as my cost of acquisition is the income, business income I had offered in the year in which I have received the VDA. So that particular information is required, because moment you claim a cost, there is definitely a mapping element available that once you have made a payment, where is the TDS attributable to that?
So in that case, assessees or as a tax professional, we need to check with the assessees the stock of or the statement of VDAs where they would have received some VDAs without any in kind basically. And
Correct.
so we need to offer the corresponding income in the year in which that currency is, the crypto is received. So
Correct.
that subsequently when these cryptos are monetized in the regular currency, that point you would have that benefit of cost.
Correct. Not only just that, because the moment the year in which I receive a VDA, the responsibility is also on the professional consultant, the person who is receiving the VDA, to ensure that he deducts TDS on the VDA that is received, because it is somebody who is parting away his VDA
Right.
for consideration of a professional service. So therefore, it is the onus is on the assessee, on the taxpayer, that moment he receives the VDA, he also ensures that the TDS is being deducted and paid. So as far as the IT return is concerned, the filing is concerned, one has to be very specific in the sense that the data has to be reported only in terms of the sales that is done, the corresponding purchase, and the net profits which are made are being only offered for tax. The ones which are into losses, I would say that you file those losses in the IT return, so that in terms of the filing aspect, it becomes a complete information of all the sales made. So one may not eliminate the ones which are into losses as non-reporting segments and file only ones which are into profit, because government has the information of sale. They might be interrogate that the total sale is this much, but I received only information for this many sales which are in profits. What about the remaining sales? So then it becomes a point for investigation for the officers or the CPC to issue a notice that you have underreported certain income. So as a matter of practice, I would always advise that you file all the sales considerations made during the year, whether into profits or into losses, irrespective of the condition. And ones which are in on profits, you will be paying tax. And the proposition which I advise is you go under capital gains, so that at least you have a quarterly breakup available. And the quarter in which you have made the gains, will pay tax from that quarter onwards, not from the day one.
Any questions from the participants as far as virtual digital assets go? And we can move forward.
Yeah. So one of the items of the disclosure is the disclosure of assets and liabilities, Schedule A. This is applicable only when the assessees have the income above 50 lakhs, and wherever the income is above 50 lakhs, you need to prepare balance sheet and obtain the client confirmation on the same. Because what the important aspect is that when you have this kind of a balance sheet where the books are properly not maintained, in case of an assessee who is salaried employee and he has income more than 50 lakhs, In such cases, the proper records might have not been maintained by the assessee. So it is imperative that you start maintaining records for them. And in terms of the balance sheet, one of the reporting requirements which has been changed is that whenever you have received any funds from the individual specified under 48 which are related party, then you report it under the advances heading under source of funds. They want to track that any fund movements within the related party transactions. Also, one of the aspects that I would want to draw the attention is that wherever you have lent money or wherever you have received money, to ensure the person with whom you have lent money or borrowed money has been filing the return under what heads to try to, if possible, we find the information or the clarity from him that what he is filing. Because even for him, if he's under business, he is required to file the list of borrowers in his ID return if he's a corporate. And in such cases, if he files the borrowers as our name, and if we don't report, if it is applicable to us in terms of our assets and liabilities that we have advanced such money to them, there is a gross misreporting between the two assessees. This acts as a source of information for the department to basically have any inquiry or any proceedings to. Again, since we are doing some work for the client in terms of the balance sheet and which has a lot of discretion, it is always advisable that we have clarifications from the client. And again, we do not need to sign their balance sheets. So when you are preparing assets and liabilities more than 50 lakhs, it is not required for you to sign any balance sheet for the client. So you ensure that you don't end up signing anything which is not required. Also, you may educate the client that, sir, if you don't report any of your assets today, and tomorrow it is found out that you have such assets, you may lead to an addition in your hands under section 69, 69A or 69B as undisclosed investments or expenditures. Another one aspect is that disclosure of directorship or shares in unlisted companies. Now nowadays like people are being directors in a company or start their company or startups, or they have investment in some startups here and there, and they don't disclose that they have such investments. But ideally, every investment in unlisted equity space has to be reported in the IT return. You are required to report your cost of acquisition, the face value of the shares, and the which year that you have obtained those shares, everything, the number of shares that you are holding. So this is very important. And second is that the if the client does not provide you any deal or anything, you can check online by mentioning the name of the client, and you primarily get some deal information. And through deal on the MCA portal, you can find out the companies in which the assessees are director, and accordingly you can get those information and question the clients about their relationship with those companies and their reporting requirements applicable to the assessee. So these are the information one needs to get. You can get some information, some clue about the assessment. So the changes in the ITR. Now this is basically what we are trying to summarize. And what are the changes which have been made in the ITR? So in this ITR, this year ITR 1 is that option of to avail the benefits the new regime BSC is provided in the ITR 1. Option is available within the due date. One has to take the option within the due date. Beyond due date, if you are filing, you may not get the option. ITR 1 cannot be filed by the assessee who is having TDS under 194N, especially in case of a TCA. Then resident individuals having income tax deferred on ESOP is restricted to file ITR 1. So if you are having ESOPs, then you probably will not be required to file ITR 1 and will file ITR 2. Quarterly breakup of dividend income. Schedule DI is more. In donations, you have to mention the date of donation made in cash to calculate the eligible amount of donation, the ETGGA. So ITR 2, again, this is one of the provisions which are introduced for the FPI, foreign portfolio investor in FI. So you need to mention the SEBI registration number. So
Yes, Chintan bhai. Yes, Chintan bhai, you are audible.
Wireless wire वाला.
Now it's audible.
Kunal bhai, can you hear me?
Yes, you are audible.
Yes, sir, you
can
are audible,
continue.
sir.
Sorry,
You can continue. You are audible.
audible. No? Okay. So in terms of the Part A General FPI, you have to mention the registration number. By entering the registration number, you can access to the schedule 115 AD. Till the time when 115 AD will not be accessible. In case of salary, again, as we said that income taxable during 89A relief provision has been added. Okay. In terms of capital gains, new field capital gain amount deemed to be long-term capital gains, previous in which asset has been transferred from AY 2021. So this new field has been inserted. VDA, as we discussed, that has been inserted. Again, income from other sources, the similar provisions of Rule 89, Section 89A has been inserted. No other change. So here, TCS provisions also, collected in the hands of any other person has been allowed to be claimed here. You can also claim like TDS, TCS also you can change interchangeably between the assessees subject to the declarations as we discussed on the 37BA. TCS also has been revamped to include carry forward and claiming of brought forward TCS also. So even in TCS, probably in case of a sales, sales in which the TCS has been collected in terms of. So in those situations, again, you have the options to carry forward such TCS. New schedule BDA, ATCCH deductions, all these ATG donations, you are required to report the donation reference number, ARN number, in the while claiming the donations on the ATG. Under section 115 BBH, again, this new tax, this consequential effect of VDA, the tax special rate has been inserted under the Part B tax TI. So in ITR 3, you can return can be filed in response to section 153C has been added. Section new regime has been labeled, has been modified, and opt-out new field has been added as mentioned. So you have opt to on the new scheme in earlier years, no label, yes, no label is modified. Have you ever opted out in earlier years? If no, then you mention the details and acknowledgement numbers. So all these information is now been made available. Again, FPI, SEBI registration information, again, ITR 3 has been added. 40 balance sheet information, as I already informed that in the balance sheet details, this information has been added. Okay. Yeah. So again, in other sources, income schedule 89A rule that has been added. Part A trading activities, which has been two new field added turnover and income from intraday trading activities. So which we discussed in the income heads of income, business income. The trading activities now you have the option to report separately. Again, 115, 105, 15 BBH, VDA, you can have the option under business income or capital gains, and accordingly you can offer for tax. So all the information you just mentioned, it will get auto-populated in the business and capital gains. You just define the heads of income and it will get populated accordingly. Again, the ARN reference that you have to mention in the ATG donation benefits. ATIB, it has been removed because it's no more available. Sunset clause. CCH, again, the Agnipath scheme has been inserted to report the deduction benefits. TCS has been updated to claim the TDS credit of other persons has been made available.
And last not the least, thank you for your patient hearing.
Thank you, Chintan Bhai, for the wonderful presentation and the detailed discussion. We can take some questions from the audience, the participants, if any.
Chintan bhai was so clear that probably none of the participants have any queries.
Yes.
Very nicely explained, sir.
Yes, sir. So I would like to thank JCF for this wonderful opportunity. I'm sure Chintan Bhai has done a lot of background work for preparation of this presentation. We had multiple calls on deciding what issues to cover. We are, all of us are aware that the Income Tax Act as well as the return preparation would have a huge number of issues to be covered, and selecting the ones which needs we discussed within a span of 1.5 hours was very difficult. We tried to summarize and find relevant issues for members, and in case something we would have missed, we would surely be happy to get that discussion ongoing through email or subsequent interactions. So all from my side, over to you, Hiral Bhai.
Thank you, Mridal bhai. Thank you, Chintan bhai. So as a formal vote of thanks for today's Karma Yogi and Marma Yogi. So as Chintan bhai said that we have to reconcile and find out the difference between index 2 and so that income under section 56 is to be any mismatch is to be there checked or not. However, I don't think that any of us would even think that to check any other parameter with respect to today's super talk by Chintan bhai. There is absolutely no other parameter that needs to be checked. There cannot be any misreporting or underreporting for that. Thank you, Chintan bhai, for a wonderful presentation and giving your time. I, on behalf of JCF, would like to really thank you. You being a part of the JCF family itself. So, but still, as a speaker, you have to be always. We have to thank you for that. And what to say about Mrinal bhai, our Marma Yogi for the day, who actually chaired the session very nicely with his inputs, valuable inputs at each stage. Thank you so much. And I thank all the participants who have been present all through the session for being a part. Thank you so much. We'll end the
Thank you so much.
Thank you, sir. Thank you, Chintan bhai. We'll end the session.